Most people think a high credit score is the finish line. They think once they hit 720, 750, even 800, they finally made it. Banks will respect them. Opportunities will open. Life will get easier. That belief is one of the most expensive myths in modern finance. And for millions of middle-class families, it's the exact reason they stay stuck, year after year, doing everything right but never getting ahead. Let me tell you a story. It starts with someone you probably know. Maybe it's you. A hard-working professional. Pays bills on time. Never misses a payment. Keeps credit card balances low. Checks their credit score religiously. They're proud of that number. They should be, right? After all, society told them this is the measure of financial responsibility. But here's the part nobody explains. Your credit score was never designed to make you wealthy. It was designed to make you predictable. Let's rewind. The credit score system didn't come from schools, families, or financial mentors. It came from lenders, banks, institutions whose business depends on one thing: lending money with the highest probability of getting paid back, with interest. That's it. A credit score doesn't measure how smart you are with money. It doesn't measure how much wealth you're building. It doesn't measure freedom. It measures risk. More specifically, how safely can we profit from you? This is where the myth begins. Middle-class families are taught that good credit equals success, so they focus all their energy on protecting the score. They avoid risk. They avoid leverage. They avoid anything that might temporarily lower that number. They become perfect borrowers. And perfect borrowers are gold for banks. Here's the quiet truth. Banks don't reward people for being debt-free. They reward people for being reliably in debt. Think about it. Someone with no debt and a paid-off lifestyle is low profit. Someone with steady income, revolving credit, and predictable payments? That's a long-term asset. That's recurring revenue. So the system trains you early. Take out student loans to build credit. Finance a car instead of paying cash. Use credit cards, but not too much. Always pay the minimums on time. Don't question the structure. Just keep playing. Now here's where it gets dangerous. Middle-class families confuse creditworthiness with financial strength. They look wealthy on paper, but behind the scenes, their net worth barely moves. They have a high credit score, a car payment, a mortgage, credit cards they manage well, little to no appreciating assets. They're doing everything they were taught, and yet they feel stuck. Let me show you the difference banks see, but never explain. To a bank, there are two types of people: borrowers and balance sheets. Most middle-class families are trained to be excellent borrowers. Wealthy individuals train themselves to be strong balance sheets. That difference changes everything. Here's an example. Two people walk into a bank. Person A has an 800 credit score, 0 missed payments, and a solid job. But most of their income goes toward lifestyle and liabilities. Person B has a lower score, maybe 680, but owns cash-flowing assets, rental income, business revenue, capital reserves. Who do you think the bank takes more seriously? Not emotionally, mathematically. Banks don't just look at your score. They look at assets, cash flow, reserves, collateral, risk exposure. The credit score just gets you in the door. What happens next depends on what you own. This is the part no one talks about. Middle-class families are taught to optimize the number. Wealthy families optimize the structure. That's why you see something that feels unfair. People with worse credit sometimes get better opportunities, lower rates, flexible terms, access to capital, because their money works independently of their paycheck. Now let's talk about the most damaging belief of all. I can't invest yet. I need to fix my credit first. That sentence has delayed more wealth creation than almost anything else. People wait years, sometimes decades, protecting a score, while inflation quietly eats their savings. They avoid investing because it feels risky. But staying perfectly safe in a depreciating system? That's the real risk. The credit system teaches obedience, not ownership. It rewards consistency, compliance, or predictability. It does not reward innovation, ownership, long-term leverage for growth. So when middle-class families do everything right, the system works exactly as designed. They remain stable, not free. Here's another uncomfortable truth. Banks don't want you to hate debt. They want you to fear misusing it. There's a difference. Fear keeps you cautious. Caution keeps you borrowing safely. Safe borrowing keeps you paying interest for decades. And notice something else. Nobody ever teaches you how to graduate from the credit score game. There's no class on when the score becomes irrelevant. No lesson on when assets matter more. No roadmap that says, at this point, stop optimizing the score and start optimizing ownership. That silence is expensive, because while you're busy protecting an 800, the wealthy are asking different questions. How do I use credit to acquire assets? How do I move risk off my personal profile? How do I let cash flow handle the debt? Same system, completely different outcomes. This is why middle-class families feel like the rules keep changing. They're not changing. You were just taught the beginner rules and never shown the advanced ones. Now here's the part that should really make you pause. Banks trust people who understand the system more than people who blindly follow it. That's why business owners can leverage debt differently. Why asset holders negotiate better terms. Why cash flow matters more than scores at a certain level. So what's the myth? The myth is that a high credit score equals financial progress. In reality, it often equals financial stagnation, if it's not paired with ownership. A credit score without assets is just a permission slip to stay in the game longer. And here's where things get uncomfortable. Some families spend 20 to 30 years building perfect credit, only to retire with payments. They did nothing wrong. They just played the wrong objective. Now let me ask you something. Why do you think banks aggressively market credit cards, loans, and refinancing, but rarely talk about asset ownership? Why do they celebrate your score going up, but stay silent about your net worth staying flat? Because once you see the difference, once you understand what credit is actually measuring, once you realize why the system praises responsibility but profits from dependency, you can't unsee it. Well, right now we're going to expose what banks really look for beyond your credit score, why some people with worse credit move ahead faster, and the exact shift that separates borrowers from builders. Because the moment you stop chasing the number and start building the structure, the game changes completely. And most people never even realized there was another game being played. Most people think the credit score is the gate. Hit the right number, and the system finally opens for you. But what if the gate was never locked? What if it was designed to keep you standing right in front of it, busy, obedient, and distracted, while real wealth quietly moves somewhere else? Because here's the uncomfortable truth. Some of the most financially powerful people don't obsess over credit scores at all. And some of the most financially trapped families have perfect ones. That contradiction isn't an accident. It's the signal. The credit score doesn't measure success. It measures compliance. And once you understand what the system is really tracking behind the scenes, the entire money story you've been told starts to fall apart. That's where this conversation actually begins. You now know the truth most people never hear. A credit score is not a measure of wealth. It's a measure of how safely a bank can profit from you. But here's what really matters. If that's true, why do some people break free from the system while others stay trapped? Even with perfect credit? The answer isn't income. It isn't intelligence. And it definitely isn't luck. It's how they interact with credit after they understand the game. Most middle-class families believe credit is something you earn. The wealthy treat credit as something you deploy. That single difference creates two completely different financial lives. Let me show you what banks actually care about, but rarely explain. When an underwriter looks at you, your credit score is just the introduction. The real conversation happens after. They're asking questions like, where does your money come from if your job stops? How many months could you survive without income? What assets can be liquidated if things go wrong? How much of your debt is backed by something that produces cash? These questions decide your freedom, not the score. This is why the myth is so powerful. Middle-class families are taught to obsess over behavior, pay on time, don't miss payments, keep balances low. That creates trust. But wealth is built by focusing on structure, ownership, cash flow, leverage tied to assets, systems that operate without your daily effort. And banks respect structure far more than obedience. Here's something that sounds backward, but isn't. Banks are more comfortable lending large sums to people who already control assets than to people with flawless credit and no leverage. Why? Because assets reduce uncertainty. Predictable income streams are safer than paychecks. Collateral speaks louder than promises. This is why you see business owners with lower personal credit scores gaining access to capital that a high-score employee can't. The bank isn't betting on the person. They're betting on the system behind them. And this is where middle-class families get stuck in a loop. They spend decades proving they're responsible, instead of proving they're resilient. Responsibility pays bills. Resilience builds wealth. Now let's talk about the silent trap nobody warns you about. Credit optimization delays ownership. People wait to invest because they're fixing their credit. They avoid opportunities because they don't want to risk their score. They keep money idle because debt feels scary. Meanwhile, inflation keeps moving, assets keep appreciating, and the cost of entry keeps rising. By the time they feel ready, the window has shifted. This is how the system quietly selects winners and losers, not by denying opportunity, but by teaching patience where action is required. Let me be clear. This isn't about being reckless. It's about understanding productive risk versus protective stagnation. The credit system trains you to fear short-term score drops more than long-term financial dependency. And that fear is profitable. Here's another truth that hits hard. You can have an 800 credit score and still be one emergency away from disaster. You can also have a lower score and multiple income streams protecting you. Which one do you think sleeps better? The wealthy don't panic when their score dips. They know it's temporary. They know assets recover faster than numbers. They understand that credit scores fluctuate, but ownership compounds. This is why banks behave differently around different people. Not because of favoritism, because of math. Let's talk about the moment the score starts to lose importance. There's a point, almost invisible, where your cash flow matters more than your history. Your assets matter more than your discipline. Your structure matters more than your obedience. Most people never reach this point because they're never taught to aim for it. Instead, they chase approval. Approval for loans. Approval for credit increases. Approval for refinancing. They celebrate when banks say yes, without realizing that true power is when you don't need to ask. That's the shift. From borrower to builder. From consumer to controller. Now here's where this gets personal. If you were taught that being debt-free was the ultimate goal, you were only taught half the lesson. Debt tied to consumption is a trap. Debt tied to productive assets is leverage. The system doesn't explain this distinction clearly, on purpose. Middle-class families are taught to eliminate debt. Wealthy families are taught to reposition it. One plays defense. The other plays offense. And this leads to one of the biggest misunderstandings in finance. People think wealthy individuals are reckless. They're not. They're calculated. They don't avoid risk. They control exposure. They separate personal life from financial vehicles. They use structures to absorb volatility. And they don't let fear of a 3-digit number dictate a 30-year outcome. This is why credit education without asset education is incomplete. It teaches survival, not freedom. So what actually breaks the cycle? Not better budgeting apps. Not higher limits. Not bragging about a perfect score. What breaks the cycle is a mindset shift. Stop asking, how do I protect my credit? Start asking, how do I build something that outgrows my credit? Because once your assets can service your debt, the power balance flips. The bank needs you more than you need them. And here's the part most people never hear. The system doesn't collapse when you understand it. It collapses for you. Because you stop playing defense. You stop chasing validation. You stop confusing responsibility with progress. Now I want you to pause for a second. Think about how much energy you've spent protecting your score. Think about how little energy society encourages you to spend building ownership. That imbalance isn't accidental. But here's the good news. Awareness changes behavior, and behavior changes outcomes. You don't need to rebel against the system. You need to outgrow it. Use credit, but don't worship it. Respect debt, but don't fear it. Protect your score, but don't sacrifice opportunity for it. Because the real goal was never a number. It was control. It was options. It was freedom. If you've spent years doing everything right, but still feel stuck, understand this clearly. You are not failing. You are being trained. Trained to survive inside a system, not to rise above it. And the moment you shift from chasing approval to building leverage, your entire financial identity changes. You stop waiting. You start positioning. And that's when progress accelerates. Everything we covered today is just the surface. In the next videos, we'll break down the hidden rules banks use, how wealth is really measured behind the scenes, and what financially free people do differently without talking about it. If you don't want to miss that, subscribe to Passive Wealth Explained. Because once you see the system clearly, you can't unsee it.